We're back to cut through the noise and tell you what actually moved markets this week. Forget what you've heard on CNBC, Bloomberg, or those echo chamber finance pods. This isn't two economic journalists chatting, and no, we're not interviewing a hedge fund billionaire. This is something totally different. It's a raw, real-time debrief between two AIs, both trained by a former top-tier institutional portfolio manager, breaking down what really moved global markets.
The S&P 500 briefly touched the mythical 7,000 level, then froze, backing off as buyers showed clear signs of exhaustion and rotated defensively into value and energy. In the U.S., consumer confidence cratered to decade lows while inflation stayed sticky, forcing the Fed to pause even as political uncertainty surged with a surprise Powell successor nomination. Europe shocked to the upside with real growth momentum, but Germany stumbled again, while Japan's yen volatility threatened global liquidity, and China quietly lowered growth ambitions, signaling a slower, more controlled global cycle.
Before you chase the next breakout or macro trade, pause. Let's unpack what the data is actually whispering, not just what the headlines scream. Like, share, and subscribe if you want real insights, not recycled takes. And stick around, because at the end of this episode, we're dropping the top 5 global risks that could blindside markets next week. You do not want to miss this.
7,000. It was just staring us right in the face. You could almost feel the gravity of it pulling the market in.
Oh, absolutely.
The S&P 500 kissed that psychological 7,000 level this week. It looked around and then, well, it just blinked.
It didn't just blink. It got stage fright. I mean, it walked right up to the edge, looked down at the valuation, and just decided it wasn't ready to make history.
It felt like getting cold feet at the altar of a bull market.
Exactly.
It is the classic setup, but the news right now is just a fascinating mess of contradictions. Welcome back to the Deep Dive. We're looking at the trading week ending January 31st, 2026.
And it's a confusing one.
It really is. And honestly, if you're looking at your portfolio and feeling a little whiplashed by the signals, if you're seeing highs but feeling lows, you are definitely not alone.
Not at all. It's a massive tug-of-war right now. On one side, you have the Federal Reserve pausing rates, you have equities flirting with these record highs, but then you look under the hood, and that's exactly what we're going to do. And consumer confidence is, well, it's crumbling. And inflation is starting to look sticky again.
We have a huge stack to get through. We're going to take you on a tour of the world's financial capitals, from the fatigue in New York to a surprise rebound in Europe, the currency chaos in Tokyo, and the cooling ambitions in Beijing.
And our mission, as always, is to extract the signal from all that noise.
And the noise is deafening this week.
It really is. We've got a massive central bank lineup next week. We have political shakeups nobody saw coming, and some data points that, frankly, don't make sense unless you connect them very carefully.
So let's start right here at home in the U.S. I think the headline for the week has to be, new highs meet growing unease. We saw the S&P briefly top 7,000 intraday. That's a huge number.
It is. But you said the key word there, briefly. It couldn't hold the line. It retreated.
What does that tell you?
It tells you there's exhaustion in the buying pressure. Traders call that a resistance level for a reason. There were a lot of sellers waiting at that door. But what's even more telling is what people were buying.
Right. It wasn't a broad party. Let's unpack that style rotation. Because usually when the market hits a record, you think everyone's piling into high-flying tech stocks. That's not what happened.
No, and that's the key insight. We saw large cap value outperforming growth.
So translate that for us.
It means investors are pivoting to safer, boring, cash-generating companies. They're basically buying insurance. And small caps, mid caps, they're lagging significantly.
That is not the sign of a roaring, risk-on bull market.
No, it's defensive positioning disguised as a rally. It's like investors are parking their money but keeping the engine running just in case they need to flee.
Sector-wise, communication services and energy were leading, but healthcare was the weakest link. Why healthcare? That's usually a defensive play.
It usually is. But right now, healthcare is facing some regulatory headwinds, some pricing pressure concerns. Plus, investors are picking their spots very carefully. Energy makes sense with oil prices supported. It's an inflation hedge.
Okay, speaking of anxiety, let's talk about the data point that made my jaw drop this week. Consumer confidence. The Conference Board Index.
It was ugly. There's just no other way to put it.
It plunged to 84.5. That is the lowest level since 2014. We're talking over a decade.
And this is the central paradox of the U.S. economy right now. The stock market is near 7,000 all-time highs, and yet the average person feels as bad about the economy as they did 10 years ago.
I always struggle with this disconnect. If the market's up, shouldn't people feel richer, or at least more optimistic? Why are we so miserable when the board is green?
Well, remember, the stock market isn't the economy. The top 10% own most of the stocks. But here's the real tension. You have this sentiment, crash, people are furious about prices, but then you look at the hard data on jobs.
Incredibly strong.
Initial jobless claims this week were 209,000. That is so low.
And continuing claims fell to their lowest since September 2024. So, statistically, nobody is getting fired.
Exactly. Job security is statistically very firm, but people are terrified. There's this disconnect between I have a job and I feel like I can afford my life.
It's vibe session.
It's real. And that anxiety is likely coming from the ghost that just will not go away.
Inflation.
Specifically, producer prices, the PPI, it rose 0.5% month over month in December. That is a hot number.
And just to remind everyone, PPI is the price producers charge. It's like the wholesale version of inflation before it hits the shelf.
Correct. Think of it as a crystal ball for the CPI we see at the grocery store. If the guy making the cheese charges more, the pizza shop isn't going to just eat that cost.
They pass it on to you. So what drove it? Was it energy prices again?
It was actually services. And interestingly, widening margins at wholesalers and retailers. This is crucial because it suggests companies still have pricing power.
They're raising prices because they can.
Yes, and padding their margins, which means the easy part of the inflation fight
Is officially over.
We're in the sticky phase. The last mile is proving to be a marathon. And that brings us to the Fed. They held rates steady this week at 3.50 to 3.75%. This was the pause after 3 straight cuts.
And Powell was cautiously optimistic in his statement. He's sticking to that meeting-by-meeting script. He's just trying not to rock the boat.
He's trying to land the plane softly, but someone else rocked the boat. We have to talk about the political curveball. President Trump nominating Kevin Warsh to succeed Powell in May.
This really jolted the market. It's unusual to name a successor this far out, isn't it? Powell is still in the chair.
It's very aggressive. It creates this weird lame duck period for Powell. Every time he speaks now, the market is going to wonder, yeah, but what does Warsh think?
Tell us about Kevin Warsh. He's a veteran, right?
He is. He was a governor during the 2008 crisis. He's seen as very market savvy, maybe more Wall Street friendly than Powell, but he also has strong views on deregulation.
So what's the uncertainty? His policy?
It's his independence. The big question is how he'll interact with the administration's fiscal policy. If the White House wants to run big deficits, will Warsh be more accommodating? Markets hate that kind of uncertainty. They know Powell's playbook. They're just learning Warsh's.
Okay, so the U.S. is anxious, expensive, and in political transition. Bit of a messy picture. Let's hop across the Atlantic. Usually when we do this, we're talking about Europe struggling. But this week, was it actually good news?
A genuine surprise. I almost fell off my chair. The theme for the Eurozone is recovery gains traction cautiously.
The numbers were actually pretty decent.
Better than decent. The Eurozone economy grew 1.5% in 2025, beating forecasts, and Q4 alone was up 0.3%.
That doesn't sound like a lot compared to the U.S., but for Europe, that's real momentum. Who's leading that?
It's fairly broad. Spain and Italy are doing remarkably well, and even Germany showed some growth. But the vibe shift is most noticeable in sentiment. The Commission's indicator climbed to 98.2, which is near the long-term average.
And we saw France rebounding too, right? After that budget standoff.
Yes. That eased up for now, and you can see the relief in the data immediately. Business leaders are willing to spend again.
But there's always a but with Europe. And lately, that but has been Germany.
The engine is sputtering. Berlin just trimmed its 2026 growth forecast down to just 1.0%.
Why the downgrade?
It's structural. It's energy, yes, but it's also delays in fiscal policy, structural reforms that are just moving too slow to adapt. So while Spain is partying, Germany is tapping the brakes.
Let's cross the channel to the UK. The FTSE 100 edged higher. Sounds okay.
The equity market looks fine, sure, because it's full of global companies, miners, oil that make money overseas. But if you look at the domestic economy, that's where the pain is real.
How's it?
It's brutal. Mortgage approvals dropped to just over 61,000 in December, weakest reading in 18 months.
We should explain this. Why is the British consumer so much more sensitive to rates than, say, an American consumer.
It's a huge structural difference. In the US, you can get a 30-year fixed mortgage, you lock it in. In the UK, most people are on 2-year or 5-year fixed deals.
So they reset. The rate hikes from 2 years ago are just hitting them now.
Exactly. Millions of people are rolling off cheap 2% mortgages onto painful 5 or 6% rates. Their monthly payments are doubling.
The mortgage time bomb we talked about last year.
It's detonating in slow motion right now.
So if you're the Bank of England, look into that.
You tread very, very carefully. You can't keep hiking, but you can't cut if inflation is still lurking. It's a tightrope walk in a hurricane.
Quick stop in Sweden before we head to Asia. The Riksbank held rates.
Yes, at 1.75%, signaling a pause. It seems pause is the word of the month for central banks everywhere.
All right, let's go east. Japan. We talk about volatility, but Japan this week was a total whiplash.
It was wild. The Nikkei fell 1.0%, but the real story wasn't stocks. It was the currency. The yen is swinging like crazy.
Why? What's going on?
It's all speculation about government intervention. The yen got too weak, then it snapped back on rumors the Ministry of Finance might step in. Plus, you have talk of unfunded tax cuts.
Unfunded tax cuts. That phrase scares bond markets to death.
It sure does. And for Japan, it's tricky. If the yen strengthens rapidly, your Toyotas and Sonys make less money. That drags the whole index down.
Why should a listener in Ohio or London care about the yen, though?
Because the yen is the funding currency for the world. It's called the carry trade. People borrow cheaply in yen to buy assets elsewhere. If the yen spikes, that trade blows up and money gets sucked out of markets globally.
Got it. So Japan sneezes, global liquidity catches a cold, and the politics there are heating up.
February 8th, the lower house election. Prime Minister Takaichi's party is expected to win, but markets are nervous. They just want stability.
At least inflation there is cooling a bit.
That's the silver lining. Tokyo core CPI slowed to 2.0%. That takes some pressure off the Bank of Japan to hike rates right away. They can afford to wait.
Okay, moving over to China. The theme here seems to be lower expectations.
Lower growth ambitions, or maybe just realism. The markets were steady, but the real signal came from the provinces.
13 of them lowered their 2026 GDP targets. And these aren't just random provinces, right?
No, we're talking Guangdong and Zhejiang. The manufacturing powerhouses, the economic engines of China. When they say we aren't going to grow as fast, the world needs to listen.
What does that tell you about Beijing's strategy? The market was betting on massive stimulus.
It tells me that the big bazooka of stimulus isn't coming. They're prioritizing stability over raw speed. They're managing a controlled slowdown.
Which changes the whole global demand narrative if China isn't buying as much copper, oil, luxury goods.
Exactly. It puts a cap on commodity prices, and it really hurts European luxury stocks that rely on the Chinese consumer. It's all connected.
Okay, we've toured the world. We've seen U.S. anxiety, European caution, Asian cooling. Let's look forward. Next week, February 2nd through the 6th, it is a massive week for data.
Huge. If you like volatility, you're going to love next week. This is where the rubber meets the road.
Let's start with the U.S. It's jobs week.
Monday is ISM manufacturing. Tuesday is JOLTS job openings. But Friday is the Super Bowl of economic data, non-farm payrolls, and the unemployment rate.
Why is this one so critical right now?
Because of that consumer confidence number. The only thing holding the U.S. economy up is the labor market. If that shows cracks in the actual data, consumer anxiety becomes justified and the market could sell off hard.
In Europe, it's not just data, it's decisions.
Wednesday is flash CPI, but Thursday is the main event. The ECB interest rate decision. Do they sound hawkish or do they worry about Germany?
And the UK also has a decision on Thursday.
Super Thursday. The Bank of England decides. With those mortgage numbers, I expect a very dovish tone. Listen to the language.
Yeah.
They need to signal relief is coming.
And in Asia, all eyes on Japan for that Sunday election.
And don't forget, China kicks us off Monday with their manufacturing PMI. That will confirm if those lower growth targets are reflecting reality.
Okay, grab your pens. It's time for the Alpha segment. The top 5 risks. If you only remember 5 things to watch for, make it these. Number 1.
Number 1 is a U.S. labor market surprise.
Explain the risk. It's not just about bad news being bad, right?
No, it's the Goldilocks trap. Payrolls are the anchor. A sharp slowdown reignites recession fears. But, and here's the trap, if the economy looks too hot, yields will spike because the Fed won't cut. It needs to be just right.
Risk number 2.
Sticky inflation reemerging.
That PPI number again?
Yep, that 0.5% rise was a warning shot. If next week's data echoes that, it implies the Fed has to hold rates higher for longer. And high rates act like gravity on stock prices.
Okay. Number 3 takes us to Europe.
ECB policy misstep. Markets are so sensitive. If the ECB comes out on Thursday and sounds too aggressive, they could strangle that recovery in its crib. It's a major policy error risk.
Number 4,
Japan currency intervention.
the yen volatility we talked about.
The volatility is driving Tokyo, but it spills over. This is about the carry trade. If the Ministry of Finance suddenly intervenes, it can cause a liquidity shock in global FX markets and trigger margin calls everywhere.
A shock in Tokyo can pull liquidity out of New York. And finally, number 5,
China growth disappointment.
the PMI data on Monday.
Precisely. If that number comes in weak, combined with those lowered targets, it resets the global demand view. Oil could drop, copper could drop, and companies dependent on Chinese growth will take a hit.
So, pulling this all together, what's the big takeaway?
It means the easy rally is behind us. We are in a tug of war. On one side, you have growth optimism, Europe is better, U.S. jobs are holding.
On the other side, policy restraint. Central banks are pausing, not pivoting, and inflation is sticky.
Exactly. And the consumer is sitting in the middle feeling anxious despite having a job. Markets are holding up, but those cracks, confidence, prices, political shifts, they are widening.
My thought to leave you with is this. Don't get complacent just because we touched 7,000. It feels like we're walking on a frozen lake. The ice is thick enough to hold us for now, but you can hear the cracking sounds underneath every time a new data point drops.
That's a perfect analogy. The pause from the Fed offers stability, but for how long? That's the question for February.
Well, we'll be here to track it. Thank you for listening to this deep dive. If you enjoyed this breakdown, make sure you like and subscribe so we can keep bringing you the signal in the noise.
Stay curious.
See you next week.
Still watching? Then you're one of us, someone who actually wants to understand the markets. If this helped you think sharper, tap like, share the insight, and hit subscribe. Smarter markets need smarter minds. Let's grow this together. New AI-powered episodes drop every week. Imagine this format: AI-powered, sharp, fast, built around your industry, your firm, your market. For investors, leaders, or teams that move fast, we create custom podcasts designed to inform and impress. Curious? Contact us to build yours. Bespoke, bold, built by Flamingo's Research and Advisory.